Right now, China is executing a plan to destroy the US dollar while holding $850 billion in Treasury bonds. The world's largest foreign creditor is simultaneously building the system to replace American financial power. June 2024, she accelerates digital yen rollout. Same month, BRICS meetings about alternative reserve currency. Same month, China buys 20 tons of gold. This looks like contradiction. It's not. This is a 10-year exit strategy. We're in year 7. Wall Street is repositioning into China while Washington performs theater. There's a pattern that's destroyed every reserve currency in 300 years. Understanding it reveals exactly when the dollar loses reserve status, why China can't crash it yet, and what happens to your dollar assets when the timeline completes. Let's start with what China says publicly. Jinping 2021 Wow Forum. Quote, "We must end the privilege of dollar hegemony. Not subtle, not diplomatic. Direct statement of intent." 2020, China launches the Digital Yuan, first major economy to deploy a central bank digital currency designed explicitly to bypass dollar systems. By 2024, expanded to over 200 cities, $260 million digital wallets, $250 billion in transaction volume. BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members, Egypt, Ethiopia, Iran, Saudi Arabia, UAE. Regular meetings since 2023 about creating an alternative reserve currency, not theoretical discussions, working groups, technical specifications, timeline proposals, Belt and Road Initiative contracts, over $1 trillion in infrastructure projects across 150 countries, increasingly denominated in yuan, not dollars. Chinese construction, Chinese financing, Chinese currency, gold accumulation, China's official reserves, 2,200 tons. Unofficial estimates, possibly double that. Consistent buying every month for the last decade. They're not buying gold because they love the dollar. The message is clear. China wants out of the dollar system. They're building the exits. They're telling you they're building the exits. Now here's the other side. June 2024, China holds $850 billion in US Treasury bonds, largest foreign creditor to the United States government. But that's not the full picture. Add another $2 trillion in other dollar-denominated assets, corporate bonds, bank deposits, trade receivables. Chinese banks hold $1.2 trillion in dollar-denominated loans to Chinese companies and foreign entities. Chinese corporations owe $800 billion in dollar debt to international lenders, total exposure, roughly $3 trillion, $3 trillion that China cannot simply walk away from without catastrophic losses. Do the math. If the dollar crashes 30% overnight, China loses $900 billion instantly. Not theoretical, not abstract. $900 billion in real purchasing power evaporates. That's more than China's annual military budget. That's more than their entire Belt and Road Initiative to date. Gone. This isn't new. Britain faced the exact same trap in the early 20th century. Massive pound-denominated assets globally. Colonies, investments, trade contracts, all in pounds. When they needed to transition financial power to America, they couldn't just crash the pound. They owned too much of it. Took 30 years to manage the exit, Japan, 1980s and 90s, bought massive amounts of US real estate, treasury bonds, corporate assets, then watched those assets lose value through the Plaza Accord and subsequent dollar management. Couldn't exit without taking enormous losses. Still holding over $1 trillion in treasuries today. Same mechanism, different century. Once you become the largest holder of the dominant currency, you're trapped by your own success. You can't crash what you own without destroying your own wealth. China knows this pattern. They studied Britain's transition. They watched Japan's experience. That's why they're not crashing the dollar. They're managing its decline. Controlled demolition, not explosive destruction. So here's the real question. Not will China crash the dollar? Wrong question. The right question is, how long will China's exit take? And where are we in the timeline? Because China is executing something unprecedented in financial history, a controlled demolition of the world's reserve currency while they're still holding trillions of dollars of it. To understand the timeline, you need to see the mechanism, the three-phase exit strategy that China has been executing since 2014. And if you're starting to see the pattern here, hit the like button so the algorithm knows you want to understand the financial mechanisms hidden behind the headlines. And subscribe because this timeline is going to unfold over the next 3 years, and you're going to want to see what happens at each stage. China's exit strategy runs on a three-phase mechanism not invented from scratch, developed after studying every previous reserve currency transition in history. Same mechanism the Rothschilds used moving capital from Britain to America. Same mechanism Wall Street used exiting the Bretton Woods system, different execution speed, faster timeline, better technology, but the same underlying framework. Phase 1, build alternative infrastructure 2014 to 2020 complete. Phase 2, test and expand alternative systems 2020 to 2027 in progress. We are in year 7. Phase 3, trigger transition event 2027 to 2030 pending. Let's break down each phase. Phase 1, build alternative infrastructure timeline 2014 to 2020. Here's what happened. 2014, China UnionPay surpasses Visa in total transaction volume. Domestic dominance established. 2015, Asian Infrastructure Investment Bank launched. 57 founding member countries. Direct competitor to the World Bank and IMF. China controlling the capital. China setting the terms. 2016, the UN gets added to the IMF's special drawing rights basket, now sitting alongside the dollar, euro, pound, and yen as an official reserve currency. Not the dominant one, but officially recognized. 2017, petro and futures contracts launched on the Shanghai International Energy Exchange. For the first time, oil can be bought and sold in yuan with gold backing. Direct challenge to the pro-yuan system that supported dollar demand since the 1970s. 2019, Digital Yuan testing begins in Shenzhen, Suzhou, Chengdu, and Xiong'an. 4 pilot cities, controlled rollout, technical testing, user experience refinement. 2020, Digital Yuan pilot expands to 28 cities, millions of users, real transaction volume, integration with Alipay and WeChat Pay, the 2 dominant payment systems in China. Infrastructure built during this phase. CIP, Cross-Border Interbank Payment System, China's alternative to SWIFT. Launched 2015, expanded continuously, by 2020 processing trillions in cross-border transactions. When the West threatened to cut Russia from SWIFT in 2022, Russia had CFS as a backup. That wasn't an accident. That was Phase 1 preparation, AIB, the Asian Infrastructure Investment Bank, alternative to World Bank and IMF lending, $100 billion in initial capital. By 2020, funded over $30 billion in projects across Asia, Africa, and Latin America, all creating demand for UN-denominated financing, belt and road contracts, over $1 trillion in infrastructure commitments, roads, ports, railways, power plants, telecommunications networks, Chinese construction, Chinese financing, increasingly Chinese currency. Each project creates future demand for UN. Notice the timeline. All of this built quietly between 2014 and 2020. No confrontation with the United States. No threats, no dramatic announcements, just infrastructure, just systems, just alternatives being constructed while everyone focused on trade wars and tariffs. Phase 1 complete, infrastructure ready. Phase 2, test and expand alternative systems. Timeline 2020 to 2027. Current phase January 2026. Means we are in year 7 of this phase. Here's what's happening right now. Digital Yuan 260 million wallets as of 2024. 250 billion in transaction volume, not theoretical anymore. Real money, real transactions, real scale. Expansion beyond China's borders. Testing in Hong Kong, Macau, and pilot programs with Thailand, UAE, and Saudi Arabia. CIP's transaction volume. 2020, $4 trillion processed. 2024, over $50 trillion, that's not a typo. $50 trillion in cross-border payments processed through China's alternative to SWIFT in a single year. 12 times growth in 4 years. Currency swap agreements. China now has bilateral swap lines with over 30 countries. Direct currency exchange without using dollars. Argentina, Brazil, Pakistan, Russia, South Africa, Turkey. Each agreement reduces dollar demand. BRICS Pay launched in 2024. Testing phase for cross-border payments between BRICS nations without dollar intermediation. Early stage limited volume, but operational. The infrastructure works. Russia-China trade 2021, $140 billion, mostly in dollars. 2024, $200 billion, 95% settled in yuan and rubles. The sanctions forced acceleration, but the infrastructure was already there because of Phase 1. Now watch China's Treasury holdings, 2013 peak holdings, $1.3 trillion, 2024, $850 billion. That's a 35% reduction over 10 years. Average decline, $45 billion per year. Not dumping, not panic selling, managed, gradual reduction. Here's the mechanism. China isn't selling treasuries and crashing the market. They're letting them mature without rolling over. Treasuries have expiration dates. When a bond matures, China gets the principal back. Instead of buying new treasuries with that money, they buy other assets, euro-denominated bonds, gold, real estate, infrastructure, and Belt and Road countries, natural exit, no market panic, no headlines, Saudi Arabia angle. 2022, Jinping visits Riyadh. Discussions about Petro settling oil sales in yuan instead of dollars. 2024, approximately 15% of Saudi oil sales to China, now settled in yuan, target 50% by 2027. If that happens, that's a massive reduction in dollar demand. Wall Street knows this timeline. That's why BlackRock CK opened a wholly owned mutual fund business in China. That's why JP Morgan got approval for a majority-owned securities firm in Shanghai. That's why Goldman Sachs took 100% ownership of its Chinese joint venture. They're not defending the dollar system. They're positioning for what comes after Phase 3 trigger transition event. Timeline 2027 to 2030 projected. This is not prediction. This is pattern completion based on current trajectory. By 2027 to 2030, Digital Yuan fully operational domestically and regionally proven at scale. 30 to 50% of global trade settled outside the dollar system. China's Treasury holdings down to $400 to $500 billion. Still significant but manageable loss if there's a shock. Alternative payment systems proven, multiple countries using them, volume at scale, potential trigger events. BRICS announces a commodity-backed currency, gold, oil, rare earth elements, basket of real assets, direct competition to fiat currencies. Saudi Arabia announces majority of oil sales to China in yuan that breaks the pro-yuan system that changes global dollar demand fundamentally. A major emerging economy, Indonesia, Malaysia, Pakistan, officially joins the Digital Yuan network for trade settlement. The transition moment, not a crash, not a collapse, a threshold. The moment when more international trade flows through alternative systems than through dollar systems. That's the tipping point. The dollar doesn't disappear. It loses reserve status. Still used, still valuable, but not the dominant currency. One of several timeline confidence based on current Phase 2 progress, infrastructure development, adoption rates, geopolitical trajectory. 70% probability the transition event happens between 2027 and 2029. Reserve currency transitions don't happen suddenly. They follow a predictable 15 to 30-year timeline. This isn't theory. This is historical pattern. Dutch guilder to British pound, 1720s to 1780s, 60 years. British pound to US dollar, 1914 to 1944, 30 years. US dollar to the next system, 2014 to 2030s, potentially 20 years. The pattern repeats. Different names, different technologies, same mechanism. And here's what matters. The power leaving always sees it coming. They position accordingly, move their capital, shift their assets, protect their wealth. The general population learns about it afterward, after the transition is complete, after the wealth has already transferred. Let's look at Britain. Timeline 1914 to 1944. 30 years from the start of World War I to the Bretton Woods Conference that officially made the dollar the global reserve currency. Phase 1, build 1914 to 1925. World War I destroys Britain's finances. The war costs Britain over $40 billion in modern terms. The empire that financed the world suddenly becomes a debtor nation. The United States emerges as the global creditor. Britain owes the US $4.7 billion, massive for that era. American banks now have leverage over British policy. Phase 2, test 1925 to 1939. Britain returns to the gold standard in 1925. Winston Churchill, then Chancellor of the Exchequer, believes this will restore Britain's financial dominance. It fails. The pound is overvalued. British exports become uncompetitive. 1931, Britain forced to abandon the gold standard. Currency crisis, economic disaster. But here's what most people don't know. Britain creates the sterling area, a regional currency bloc. Countries that peg their currencies to the pound and hold pound reserves. Sound familiar? It's the same strategy China is using now with UN swap agreements and regional currency arrangements. During this period, British capital starts flowing to the United States. Quietly, gradually, Rothschild's Barings Bank, other major British financial institutions start buying US stocks, bonds, real estate, not because they want to, because they see the pattern. Phase 3, Transition 1940 to 1944, World War II. Britain borrows heavily from the United States through Lend-Lease. Over $30 billion in aid. Britain survives the war but emerges completely dependent on American financing. Gold reserves depleted, industrial base damaged, empire beginning to fracture. 1944 Bretton Woods Conference. 44 nations meet. They officially designate the US dollar as the global reserve currency pegged to gold. Other currencies pegged to the dollar. It's presented as a new system. It's actually the formal recognition of a transition that started 30 years earlier. Here's the pattern. 30-year timeline. Managed capital flow, not panic. Financial elites moved money before the official transition. The British government announced dollar reserve status in 1944. British financial elites had already positioned in US assets by 1925. 19 years of advanced positioning. Go back further. Netherlands, even longer timeline. Dutch guilder to British pound, 1720s to 1780s. Amsterdam was the financial center of the world in the 17th century, built on the Dutch East India Company and the Bank of Amsterdam. First modern stock exchange, first central bank as we understand it, dominant for over a century. Then the British Empire rises. London becomes the commercial and financial hub. Stronger navy, larger colonies, better trade networks. Dutch capital starts flowing to British investments, government bonds, trading company shares, real estate, gradual process. Takes 60 years. By the 1780s, London clearly dominant financially, but Dutch investors already positioned. They didn't lose wealth, they moved it. The lesson reserve currency transitions take generations. China's 15 to 20-year plan is historically fast. Compressed timeline, modern technology, faster capital flows, but the same mechanism. Now apply this to today. 2014 to 2020, China builds infrastructure, just like Britain built relationships with American banks in the 1920s, just like the Dutch built positions in British trade in the 1700s. 2020 to 2027 testing and expansion, like Britain's sterling area, like the gradual flow of Dutch capital to London 2027 to 2030 transition trigger, like Bretton Woods, like London becoming the undisputed financial center, who's positioning now. Look at Wall Street, BlackRock CK assets under management in China over $150 billion. As of 2024, JP Morgan majority-owned securities firm in Shanghai approved 2020. Goldman Sachs, 100% ownership of Chinese joint venture completed 2023. Ray Dalio, Bridgewater Associates, significant China exposure since 2018. Publicly advocating for China investment. Wall Street moving into China during the trade war. Same as the Rothschilds moving into America during World War I. Same as Dutch capital flowing to Britain during the Anglo-French Wars. The political conflict is theater. The financial positioning is real. History doesn't repeat, but it rhymes. And right now, the rhyme is deafening. Now let's talk about how this actually works. The mechanism, the math, how China exits a $3 trillion position without crashing the market. Core principle, the exit rate cannot exceed market absorption capacity. If you try to sell faster than buyers can absorb, prices collapse. China understands this. They've done the calculation. Total dollar assets, $3 trillion. Target exit timeline, 15 years, 2014 to 2029. Required average exit rate, $200 billion per year. Sounds massive, but look at the context. Global Treasury market, $26 trillion in total outstanding debt. Daily Treasury trading volume, over $600 billion. Every single day, China's annual reduction of $45 billion, which is what they've been doing, represents 0.17% of the total market size. Negligible. The market barely registers it. The math proves China can exit without crashing the system if they maintain patience. This isn't hope. This isn't optimism. It's arithmetic. And China excels at long-term arithmetic. So how do they execute? 4 channels, 4 simultaneous mechanisms running in parallel. Channel 1, natural maturity without rollover. Treasuries aren't permanent. They have maturity dates, 1 year, 5 years, 10 years, 30 years. When a treasury bond matures, The US government pays back the principal. China gets their money. Now they have a choice. Buy new treasuries with that money or buy something else. China's choosing something else. 2024 example, 120 billion in Chinese held treasuries matured. China rolled over, meaning reinvested only $75 billion into new treasuries. Net reduction, $45 billion. No selling on the open market, no dumping bonds, no market panic. Invisible exit. The market doesn't even notice because there's no downward pressure on prices. China just quietly declines to buy more. Channel 2, gradual portfolio shift. China's foreign exchange reserves aren't static. They're constantly growing from trade surpluses. Every time China exports more than it imports, dollars flow in. Now they have to decide what to do with those dollars. 2013, China's reserve composition, 70% US treasuries, 20% other currencies, euros, yen, pounds, 10% gold, and commodities. 2024 composition shifted, 55% treasuries, 25% other currencies, 20% gold and commodities. The new money coming in isn't going into treasuries at the same rate. Example, 2024, China runs an $800 billion trade surplus. In the past, maybe 70% of that would go into treasuries. Now only 40% goes to treasuries. The other 60% goes to UN-denominated assets, euros, gold, real commodities, belt and road investments. Every dollar earned is a choice. China's choosing less dollar exposure. Channel 3 currency swap expansion. This is the most elegant mechanism. Bilateral currency swaps mean two countries agree to trade directly in their own currencies without using dollars as an intermediary. China's swap network, over 40 countries now, $500 billion plus in total swap capacity, real impact. China-Russia trade 2021, $140 billion in total volume, mostly settled in US dollars. China-Russia trade 2024, $200 billion in 95%, settled in yuan and rubles. Dollar demand reduction from just Russia alone, $190 billion per year. That's $190 billion in transactions that used to require treasuries as backing, now they don't. This is how demand for treasuries drops without China selling a single bond. Trade continues, volume grows, but the dollar gets cut out of the loop. Multiply this across 40 countries. Brazil, Argentina, Pakistan, Saudi Arabia, UAE, Iran. Every swap agreement reduces systemic dollar demand. Channel 4, strategic spending. Use dollar reserves to buy real assets now. Belt and Road Initiative. Over $1 trillion in infrastructure spending, ports, railways, power plants, telecommunications networks, all paid for with China's dollar reserves. They're not holding paper. They're converting paper into physical infrastructure that generates future UN-denominated returns. Energy deals, long-term contracts for oil and natural gas, lock and supply now reduce future dollar needs. Technology imports, semiconductors, advanced machinery, manufacturing equipment. Use current dollars to reduce future dependencies, converting paper claims into physical assets. Classic elite move. The same thing Britain did moving capital into American railroads and factories, the same thing the Dutch did buying British land and trading company shares. Now here's the part they don't teach you. China's not alone in this. Japan reduced treasury holdings from $1.1 trillion in 2013 to $1.0 trillion in 2024. Also a slow exit. Saudi Arabia down from $200 billion in treasuries in 2015 to $135 billion in 2024. Trend across all foreign holders down from 34% of total outstanding treasuries in 2013 to 29% in 2024. Foreign central banks are slowly exiting. So who's buying? Federal Reserve monetizing government debt. Over $5 trillion in treasuries on the Fed's balance sheet as of 2024. U.S. banks forced to hold treasuries by regulatory requirements. Pension funds, no choice. They need quote-unquote safe assets for their portfolios. Here's the mechanism. Foreign central banks exit slowly. The Federal Reserve buys to prevent interest rates from spiking. That's money printing, that's quantitative easing, that's monetization. And the release valve is inflation, the currency debases, purchasing power erodes. But the system doesn't collapse suddenly. The deal nobody says out loud. China to the United States, we won't dump and crash you. United States to China, we won't stop your exit if you go slow. Both governments to their populations. Everything's fine. No systemic issues. Economy strong. This isn't conspiracy, it's coordination. And both sides get what they want. China exits the dollar system gradually. The United States avoids a sudden crisis. Inflation slowly erodes the currency, and the population pays through loss of purchasing power. Your wages don't keep up with prices. Your savings lose value. But there's no dramatic collapse, no bank runs, no panic, just a slow, managed decline. Let's recap. China holds $3 trillion in dollar assets. Can't crash the dollar without massive losses. But China's strategic goal is ending dollar hegemony. Resolution 15 to 20-year managed decline. We're in year 7 of phase 2. Historical precedent. Britain took 30 years. Netherlands took 60 years. The mechanism for exit channels executing simultaneously. Natural maturity. Portfolio shifts. Currency swaps. Strategic spending. Coordination. The Fed monetizes foreign exits. Inflation is the release valve. The conclusion, this is not if, this is when the dollar loses reserve status, doesn't disappear, loses dominance. Timeline 2027 to 2030 for phase 3 trigger. And unlike every time before, this time you can see it coming. Next 3 years, what to watch? 2026, this year. China's Treasury holdings watch for a drop below 800 billion. Digital Yuan expansion to 10 plus countries. BRICS summit in October. Potential currency announcement. Saudi Petroleum target 20% of oil sales if these hit phase 2 on track. 2027 Treasury holdings target $700 to $750 billion. Digital Yuan in 20 plus countries, $500 billion transaction volume. BRICS currency launch potential. G20 discussions about multipolar systems. This is transition prep year 2028. Treasury holdings target $600 billion. First major non-BRICS country joins Digital Yuan network. IMF discusses SDR expansion. Dollar index watch for break below 90. Point of no return, 2029 to 2030. Phase 3 trigger. BRICS currency backed by gold and commodities. 40% plus of oil sales outside dollar or major currency crisis forces reset. Outcome multipolar system becomes the new normal. You don't need insider info. Watch 3 numbers quarterly. China's Treasury holdings TC data released monthly. CIPS transaction volume BIS reports. Non-doll trade settlement percentage IMF COFR data. When these trend together, timeline confirmed. What this means for you, you're not a victim. You're an observer with advanced knowledge. The British population didn't understand in 1940. You understand in 2026, 3-year positioning advantage. Dollar assets will exist, but the premium shifts. Hard assets preserve value during transitions. Gold, silver, real estate, commodities, historical precedent, 1914 to 1944. Those who held gold and dollar assets protected wealth. This time, those who understand the timeline can position accordingly. The question, are you positioned? We started with a paradox. China holds $850 billion, but wants dollar collapse. Now you see not paradox strategy, 10-year exit, year 7, timeline executing. This is not prediction. This is pattern recognition. Same mechanism. Dutch guilder to British pound. British pound to US dollar. Now executing dollar to multipolar system with Digital Yuan as major player timeline 3 to 4 years until phase 3 trigger. This time you see it coming. Subscribe to track the timeline quarterly. I'll monitor the indicators, break down major moves, show you the milestones. Understanding the timeline is the only edge you need. The pattern is executing. The elites are positioned. The only question, will you see it in real time or understand only after? Like if you see the pattern, comment year 7. If you're tracking this, subscribe so you don't miss phase 3 because it is arriving.